As the market keeps falling after what looked like a recovery, I've been keeping some additional money on the sidelines these last few weeks waiting to be invested. This is in addition to the money that I've been dollar cost averaging on a regular basis, which is something that I'm a huge advocate for. Regardless of how the market is performing, all investors should be investing on a consistent basis despite if the market is growing or falling. I just talked about it in my last video, so I won't beat a dead horse again, but this strategy is really the best because nobody can consistently time the market over and over again. But in today's video, I wanted to go over what stocks I've been buying recently outside of dollar cost averaging during the dip, as well as how much I've been spending. I'll also explain and go into detail what I like about the companies that I've been investing in. As I like to say, these are my own personal opinions and investments. You shouldn't just buy what I'm buying until you've done your own research and come to your own conclusion, and never buy a stock or fund that you feel like you don't have a good enough understanding of. Because all of these stocks currently yield over 10% does translate into them being much riskier than your typical dividend stock. So make sure that you're comfortable with that fact if you do decide to pursue any of these investments. So with that out of the way, let's go ahead and get started. The first stock I've been buying more of this week is Rhythm Capital, ticker symbol RITM. If you're thinking you've never heard of this company, you actually might have, because 2 months ago, this company changed its name from New Residential Investment Corporation, which was ticker symbol NRZ, to Rhythm Capital, which is now RITM. If you're like most people, you're probably wondering why on earth they changed their name into something so ridiculous as Rhythm Capital, but I'll explain why they did that in a bit. But this week I picked up 54 additional shares of this stock at a price of $9.12 per share. Rhythm Capital is a mortgage real estate investment trust. They provide capital and services to the real estate and financial service sectors in the United States. Its investment portfolio comprises mostly of mortgage servicing related assets, specifically mortgage servicing rights. Because it's an MREIT, Rhythm Capital is required to pay out 90% of their earnings back to shareholders in the form of dividends. Right now, their stock pays 25 cents per share every quarter, and Yahoo Finance gives this stock a dividend yield of 10.48%. I normally use Google Finance, but they haven't updated their ticker from NRZ to RITM yet, and it's not showing a dividend yield currently. So you might be wondering why New Residential decided to change their name to Rhythm Capital. They did so because a few months ago, they announced they were taking the company in sort of a newish direction, which I think is honestly a great idea. One of the largest impacts of this change is that the company is changing their management structure from being externally managed to being internally managed. Back during the New Residential days, the company actually hired an outside company to manage their investments, but Rhythm decided to break their contract with Fortress Investment Group, which resulted in them posting a multi-million-dollar loss last quarter due to breaking their contract with the company. But this move is ultimately expected to save Rhythm Capital upwards of $60 million per year, which they can better use to manage and expand their investments. You might be hesitant about this company because they are a mortgage REIT, and I've said myself in the past that MREITs are definitely not one of my favorite high-yield investments. A lot of them do have a long history of dividend cuts, and there are risks involved with this stock. But Rhythm Capital has been making moves recently that's making them significantly different from other mortgage REITs out there like Annaly Capital or Armor Residential. That's because the majority of what this company owns aren't mortgages, but rather mortgage servicing rights, or MSRs. These are a specialty of Rhythm Capital that most MREITs don't invest in. MSRs are a contractual agreement in which the right to service an existing mortgage is sold by the original mortgage lender to another party that specializes in the various functions involved with servicing mortgages. So for example, Chase Bank might offer mortgages to consumers, but hire a company like Rhythm Capital to manage it for them. In that arrangement, Rhythm Capital would be responsible for collecting and transferring the mortgage payments, managing property taxes and insurance fees, allocating principal and interest to each payment, among other tasks. Chase Bank would then pay Rhythm Capital an agreed amount for handling all of their mortgages. These are something that most MREITs don't invest in or specialize in, and yet Rhythm Capital does. What makes things better is, according to Corporate Finance Institute, when interest rates rise, there are fewer prepayments and the value of mortgage servicing rights increases. But when interest rates are low, the prepayment speed increases and the value of mortgage servicing rights decreases. Because interest rates have been rising, Rhythm Capital should be seeing increased revenue from their MSRs, which make up 42% of their investments. But they do more than just MSRs. Rhythm also owns a portfolio of other companies that handle other real estate services. I've been considering making another video that's more detailed about this company, but so far I'm really liking this direction that they're going in. The next company I just bought more shares of is Hercules Capital, ticker symbol HTGC. Right now, according to Google, their stock currently yields 10.41%, and this week I bought 59 shares of HTGC at a price of $13.44 per share. Hercules Capital is a business development company that was founded back in 2003, which makes them one of the older business development companies in this sector. Hercules Capital offers loans to high-growth companies, specifically in the technology and life science sectors, which helps them stand out among other BDCs. They're also the largest BDC that targets venture startups. According to their website, since 2003, they've made over $15 billion in commitments and have funded 590 companies. Right now, they currently have $2.9 billion worth of assets under management. They're also internally managed, which, as I highlighted with Rhythm Capital, is something that I really like because it can save M-REITs and BDCs a lot of money on an annual basis. I'm not saying externally managed companies are bad. My current favorite BDC, which is Hercules Capital, is externally managed. But internally managed companies typically post better returns when compared to externally managed companies, largely in part due to fees having to be paid to these asset managers. But other than that, there are several things that I really like about Hercules Capital in particular. They have one of the best track records in terms of growth in both their share price and their dividend distributions. With BDCs, it's pretty common for these companies to go a really long time without ever increasing their dividends. Some will go more than a decade without increasing it, and we have seen some that have never increased their dividends. The same is true in terms of share price performance. Many BDCs have flatlining share prices that don't move a whole lot. I think the gold standard in terms of share price growth and dividend increases still has to go to Main Street Capital, which is also one of my favorite BDCs, and they pay monthly dividends. But Hercules Capital does have a better than average increase of share price and dividend increases. You can see they don't always pay the exact same dividend every single quarter. It tends to move up and down, and they do pay the occasional special dividend every now and then. This chart that you're looking at doesn't take into account the special dividends that they pay, but about a decade ago their stock was paying 22 cents per share every quarter, whereas now today it pays about 35 cents per share. That's an increase of roughly 59%. That's pretty hard to beat in terms of growth for a BDC, with a few exceptions like Main Street as I just mentioned. Hercules also benefits from rising interest rates, as 94.9% of their loans are floating rate loans. This means that the company will be able to collect more revenue from their loans thanks to the Feds raising interest rates. At the same time, though, it also elevates the risk of borrowers defaulting since they have to pay more, so it's not always a guaranteed win. But given what we've looked at, I continue to be pretty optimistic about Hercules Capital going forward. TriplePoint Venture Growth is the next stock on this list, which is ticker symbol TPVG. This week I bought 38 shares of TriplePoint at a price of $13.03 per share. They're a business development company that specializes in making investments in venture-backed capital companies at their growth stage. Having been founded in 2013, the company provides debt financing to venture growth space companies, which include growth capital loans, secured and customized loans, equipment financing, and direct equity investments. They are an externally managed BDC that's based out of Menlo Park, California, and this stock is the highest yielding one that I've bought so far this week at 11.5% according to Google. TriplePoint Venture Growth is not like most BDCs that we've seen in that they're a little different in a couple of ways. They exclusively like to focus on technology, life science, and other high-growth industries similar to Hercules Capital. But TriplePoint also only lends to companies that are venture capital backed during their venture growth stage. It's a very specific period during a company's startup process where a company has already proven themselves of achieving a sizable amount of success and they're seeking additional funding in order to further expand their business. Other business development companies will lend money at other stages during a company's growth, or they'll provide financing to help rescue a company out of a dire situation through restructuring. But TriplePoint doesn't assist with those kind of businesses. So in a way, this does kind of provide protection, since in order for TriplePoint to consider offering a business financing, they would have to provide a lot of proof that they've already been pretty successful. You can see over the years that this BDC has provided financing to a lot of really popular companies. TriplePoint's had a lot of success in providing financing to businesses like Facebook, Square, Beyond Meat, Etsy, and a whole lot of other really recognizable businesses here. This is another stock that's been beaten up quite a bit this year when compared to their peers, most likely due to recession fears. But it's important to remember that this company only backs businesses that are already backed by venture capital funds, as I previously mentioned, who hold much larger stakes than TriplePoint does. Since their inception, TPVG has never had to cut their dividend, and they've paid a special dividend at times, although it has been pretty rare. And if you remember what I said about internally versus externally managed companies, TriplePoint has actually performed much better than the average externally managed BDC. Some other things I like about this stock include the fact that it's very low leveraged and most of their loans are short term, usually around 3 to 4 years, which can also help minimize defaults. At the same time, it's a much smaller company when compared to the other big players in this sector like Hercules Capital and Owl Rock Capital. Their total portfolio was only $706 million as of June of this year, and the yield on their portfolio is 14.5%, which is really high compared to a lot of other BDCs I've seen. In the end, TriplePoint is nowhere near one of my largest holdings, but it's still a stock that I'm a believer in and I'll continue to periodically invest in and reinvest my dividends. So that's going to wrap up my weekly activity, which has been more active than most weeks. But I'm still taking advantage of these lower price stocks and still anticipating prices to keep falling lower. Feel free to share any recent purchases that you've made in the last few weeks that are hopefully going to score some higher dividend payments. Like I said in the beginning, be sure to always perform your own research and come to your own conclusion before investing in any stock. Understand the risks of what you're investing in and develop an understanding of how companies you're analyzing actually make the money they pass on through dividends.